Leadership and Legacy, Smart Estate and Gift Planning. My name is Bobby Hanna, proud St. Martin's alumna, class of 2001, and I am the Associate VP of Institutional Advancement. Before I introduce our speaker today, let's review a few housekeeping items. We welcome questions as we go along. You can use the chat feature to enter your questions. I will serve as the Zoom moderator for our webinar today, which will be recorded for additional educational materials and will be available to you after today's webinar. The agenda for this session will share concepts or ideas for some ways to make charitable gifts that support you, your family, and those institutions you support, like St. Martin's. Our presenter will share ideas for ways to make gifts during a lifetime and after a lifetime. Again, questions are welcomed as we go along. Please make sure to use the chat feature for your questions, and there will be time at the end of our presentation. Before we begin, there are specific questions. If there are specific questions you want Sam to touch on, please make it for those that are not covered in the session. At the end of the session, we can circle back to answer the questions if time allows. Again, thank you for attending today and for your past and present support of St. Martin's University. As you reflect upon your philanthropic journey, you include the many causes and places that have been consistently important to you. It is possible to make gifts that can meet multiple objectives, which you will hear about a few of those today. As you think about your legacy and making charitable gifts at St. Martin's, you might consider designating gifts to endowed scholarships, or you might direct a legacy gift to an unrestricted support, which is directed by the Board of Trustees and the President. Each way you make gifts is important and offers an opportunity to align your values through your charitable gifts. Contact me to learn more about how and where to direct your legacy gifts. Our presenter today is Sam Armour. Sam is connected to St. Martin's as Vice Chair of the Board of Trustees and has served on the board since 2016. Sam is the owner and financial advisor for Armour Wealth Advisors, LLC, focusing on tax-smart financial, retirement, and estate plans for Washington residents and their families. Sam is certified financial planner, certified public accountant, and a certified investment management and analyst. Sam attended Central Washington University and Golden Gate University, where he earned a MS in taxation. When he has downtime, Sam enjoys hiking, traveling, reading, and volunteering for St. Martin's. Please welcome our presenter today, Sam Armour.
Bobby, thank you very much for the introduction. And folks, thanks for joining us. I have to admit, I'm a little embarrassed. I think I'm wearing the same shirt and sport jacket that were in that photo on the previous slide. I really do encourage you to ask questions. I want to point out, we're going to talk about a few ways that you can make donations to a charity, but there are many, many ways. And as a doctor would say, everybody's situation truly is different. So depending on who your heirs are, what charity you want to support, what type of assets you have, all of those affect the way you would make charitable donations. So I probably won't be able to touch on all of the various ways of donating, but that's not the purpose today. Today, we're really focusing on some very tax-intelligent ways to donate. Bobby, if you would, before we jump into the details, I can't emphasize enough, as you'll see on the next slide, how important it is that you have a will or a living or revocable trust. Bobby, if you would flip, please. I can't tell you, I've been in practice for, gosh, I think 26 years now, and several times I've seen people pass away without a will or a living trust. And it's a nightmare. I can almost guarantee you your assets are not going to go where you would wish for them to go. As the slide says, if you don't have a will or a revocable living trust, you pass away as what's called intestate. And what that means is the state of Washington, or whatever state you're a resident of, has laws that will dictate who receives your assets. It can be complex. I'm not an attorney, but I'll tell you that it's my understanding that first your assets would go to your spouse. That might be what you want. Then I think they would go to actually your parents. That may not be what you want. They then would go to your kids. That may not be what you want. So please, even if you aren't looking to make charitable donations, I encourage you to seek out a competent estate planning attorney and discuss with them what your wishes are for your assets upon your passing. All right, now let's dive into the meat of it, which is to discuss giving smarter, give better ways to give, and how to benefit your heirs. At St. Martin's, we have a group in our advancement team, Nate and Bobby and others, who can talk to you about the best ways you could support St. Martin's. And as I alluded to, some assets are better to give to charities, and some are better to give to family and friends. And I'll actually give you a specific example of that as we get going. So our first topic I want to discuss on the next slide is giving directly from your IRA during your lifetime. I'm going to throw out a couple of ages at you, and this can get confusing because unfortunately the IRS has different ages. They didn't coordinate these two topics. You can choose to make a donation directly from your IRA to a charity once you are 70.5 years old. If you are younger than this, then this donation opportunity does not apply to you. As a person reaches the age of 73, that's the other age I was throwing at you, you must begin taking required minimum distributions, RMDs, from your IRA and from any other qualified retirement accounts you have, such as a deferred comp plan through the state, a thrift savings plan if you're a federal employee, or perhaps you have a 401k or 403b from a prior employer. Again, once you reach the age of 73, you must take from those accounts certain required amounts each year. The following topic, this opportunity, which we refer to as a qualified charitable distribution, can only be done from an IRA, though. It cannot be done from those other retirement plans. But there is a way to make it happen from those other retirement plans, which would be to roll over those accounts into an IRA. So here are the mechanics of what a qualified charitable distribution are. As you probably know, when you take money out of a retirement plan, you are taxed dollar for dollar on that distribution. So if I take $10,000 out of my IRA, I am taxed on $10,000. But if I am 70.5 years old and I make cash donations to a charity, the best way I can make that donation is to direct my IRA to make a payment directly from the IRA to the charity, to the university. By doing that, the amount that is paid as a qualified charitable distribution from the IRA to the university does not count as taxable income. Oftentimes, both for single and married people, when we make charitable donations, we're actually not receiving a tax deduction for it because the itemized deductions that the IRS gives us are so high. It's almost $30,000 for a married couple. So again, say I'm making a $5,000 distribution or charitable donation, I might give cash of $5,000 to the university and not even get a tax deduction for it. But if I'm 70.5 and I direct that payment be made from my IRA, I'm not getting a tax deduction for it, but I've taken it out of a taxable account and have helped the university. and I can keep my $5,000 in my checking account and use that for living expenses. This is especially powerful for people who are 73 and older, who have required minimum distributions. So let's pretend that I'm 74 years old. I want to donate $5,000 to the university, and I have to take $20,000 out of my IRA. I could direct my IRA custodian to pay $5,000 to the university from my IRA, and that counts towards my required $20,000 distribution. So then I just take the additional $15,000 out of the IRA as I'm required, and I'm only taxed on the $15,000. So you can see how we just got a tax benefit by doing that. This year, this is indexes for inflation each year, but this year, a person can direct up to $105,000 from their IRA to charities as qualified charitable distributions. And again, any amount you pay to the charity is not taxable income. This actually can have a secondary effect on the taxation of other income that you have, such as Social Security benefits. It can affect your Medicare premiums and other ramifications. I don't want to get too deep into that. So with my clients, this is number one priority as far as charitable giving is concerned each year. This is the best way to give to charities. All right, let's go ahead, please, Bobby, and jump to, well, there's one bonus for this. Our next topic is charitable gift annuities. And a person can actually direct up to $53,000 from their IRA as a qualified charitable distribution into a charitable gift annuity. So it's best of both worlds, and the second world is what we're about to discuss. So now we can jump to the next slide, please. As you can see here, what we're going to discuss is an opportunity that you actually will receive some income back each year. And it's called the charitable gift annuity. So oftentimes people are seeking fixed income. And one of the ways of doing that is to turn over some money to an insurance company and purchase an annuity. And annuities come, boy, there are thousands of varieties of them, to be honest. I've always viewed them as like purchasing a used car. So it can be very confusing. But the gist of an annuity is you turn money over and you receive a fixed payment back monthly or annually for either a certain number of years or for your lifetime. What we're doing here, though, with a charitable gift annuity is instead of turning cash over to an insurance company, you're turning it over to the university or to a third party that assists the university. And you will, depending on the terms of the annuity, receive back a payment monthly, quarterly, or annually based on some nationally put out terms of the annuity, which we'll see a couple of slides from now. So you turn over some money knowing that you're going to receive something back. And because you will receive something back, you are going to receive a charitable deduction on your taxes for the contribution, but it's not the full amount of what you gave. And if you think about it, that makes sense because you are receiving something back as payment. And then where the college benefits is that at the end of the term of the charitable gift annuity or at the end of your lifetime, the university receives whatever remains of the funds that you donated, which have been invested throughout the term of the annuity. Go ahead, please, Bobby. So at St. Martin's University, you can make enter into a charitable gift annuity if you are 55 years or older, and the repayment rates to you are especially attractive if you are 70 years or older. So even if you were to make a donation at, say, age 55, you'd be best waiting until you're age 70 to receive payments. One thing we do like to warn is there is some paperwork involved in entering into a charitable gift annuity, because it is almost like, well, it's a contract. So there is more paperwork involved, but of course, the university handles that for you. And on the next slide, we'll see some examples of rates that apply, whether you are entering into the annuity as a single person, or if you're entering into it with 2 lives for spouses. These are not, like I said, these are rates that are put out by the American Council of Charitable Gift Annuities, and the payment rates change year to year. All right, now let's jump into charitable giving upon your passing. Oftentimes, like you see here, we can make a greater impact by making a larger gift through your estate. I know I personally obviously want to protect myself financially for the rest of my life. So I hesitate to make a larger donation to the university, but it's easier for me to do that upon my passing. So that's what we're referring to here. There are ways through your will or through a living trust that you can designate the university or another charity as a beneficiary for a specific dollar amount or for a percentage of your estate. And like I say, those are just terms that you put into your will or your revocable living trust. And as we've shown here on this slide, we've given an example. So for instance, if you're a supporter of the university and you give $1,000 a year, it'd be probably difficult to all of a sudden make a $25,000 donation. But you may choose to support the university by putting a term in your will that says you're going to give $25,000 upon your death to create an endowment that distributes $1,000 per year to the university. And you can even choose whether it's just general funds or you can support a specific cause within the university. For instance, I like supporting the men's soccer team. My son was a great soccer player and chose not to play college soccer. And I figured I was saving money, not paying for his soccer fees. So I donate to the university men's soccer team instead. Okay, so on the next page, you can see, I feel like I'm restating the same things repeatedly, but like I say, it's simple to put documentation in your will. The university can help you with the language. I do not suggest you do wills or revocable trusts on your own. Always seek a good attorney. But again, the university can help provide that attorney with good language to help support you. And one note we make on this slide, which I completely agree with, is for those of us who are financially conservative and we are worried about outliving our funds, making a bequest through your will is a great way to support your charity without putting your own financial life at risk. Okay. And then next is discussing naming a nonprofit as beneficiary of a retirement account. I've got a great example that I'm going to give, a real life example here. As I mentioned earlier, if you take money out of a retirement account, you are taxed on that dollar for dollar. So I take $10,000 out of an IRA, I am taxed on $10,000 of income. The same applies to your heirs. So if I pass away and I've named my daughter as the heir of my IRA, she is going to, first of all, have to withdraw the full amount of the IRA within 10 years of my passing. So depending on the size of your retirement account, that could force a lot of taxable income to your heirs in a very compressed amount of time. Secondly, she will pay income tax on the distribution from the IRA that she receives each year. But as you know, charities do not pay income tax. So let me give you an example. Let's say I had two assets. I have a $100,000 retirement account, such as an IRA or a deferred comp or a 401k. And I also have $100,000 in a bank account. And I want to give my assets 50-50 to my child and to St. Martin's University. If I allow both of those assets, the cash and the retirement account, to pass through my estate and give the assets 50-50 to my kid and to the university, both my child and the university are going to receive $50,000 cash and $50,000 of IRA. And when my daughter withdraws that $50,000 from the IRA, she pays tax on it. A better solution would be to name St. Martin's as the 100% beneficiary of my IRA and have the cash in my bank account go to my daughter. She therefore receives $100,000 cash completely tax-free. The university gets the $100,000 IRA, and they're happy to receive that because they don't pay any income tax. So you can see right there, I've saved my daughter quite a bit of income tax. And I actually had a real life situation where an attorney drew up a will that was giving $600,000 to a university. But this person, we had over $1 million IRA. And I reached out to the attorney and I said, wait a minute, let's direct $600,000 from the IRA to the university and let all of the other assets flow to his heirs. And by doing this, I literally saved probably $100,000 to $150,000 of income tax to those beneficiaries. So I hope the example I gave makes clear how this would work for you. And you can specify a dollar amount in your IRA. So pretend I've got a $500,000 IRA. I can give $10,000 to charity, or I can give a percentage of the IRA to charity with the rest going to my heirs. Okay, we've touched on everything on that page. And this is an important slide because you remember when I was talking earlier about qualified charitable distributions from your IRA. That's an annual type of gift, and you have to be at least 70 and a half years or older to make such a distribution. When we're talking about remainder beneficiaries on your retirement accounts, these are the folks who will inherit when you pass away. So of course that could apply to a 20-year-old with a retirement account. It's not just those of us who are getting older. And as you can see, you can do a full or a partial or a specific dollar amount from any of those retirement accounts. Careful coordination. If you have a revocable living trust, again, please make sure you're working with competent attorney and financial advisors for coordination of beneficiary designations, because trusts typically don't own retirement accounts, and you've got to be really, really careful about the language with your plans and with the living trust itself. And then lastly, we're going to talk about life insurance, naming a university or another charity as a beneficiary of life insurance. Typically, and by typically, I mean almost 100% of the time, payments from a life insurance policy are not taxable income. However, if you are like me and you want to make a larger contribution to the university upon your passing, using life insurance can be a great tool to make that happen. You can name the university as a beneficiary in part or in whole of a life insurance policy. And depending on the type of policy you have and your personal estate tax situation, meaning candidly your net worth, you may want to consider actually transferring ownership of the policy to the university itself during your lifetime. Because depending on your situation, this could actually help to reduce your taxable estate. In Washington, we have an estate tax, I'm rounding. Once your net worth is over $2.2 million, you're subject to Washington estate tax. Removing a life insurance policy from your estate is a great way of helping to reduce that estate tax exposure. And again, as the slide says, this is a way you can make more of an aspirational gift beyond your current spending capacities. So those are the topics we wanted to discuss. I feel like I rushed through those a bit. So I really hope, I'm going to turn it over to Bobby, but I really hope we will have some questions from our attendees.
Need to unmute myself. So we have the next steps. We have some resources available electronically. The first is our website, where articles and calculators are available to download, including a popular estate planning kit. There's also a link to a 10-minute video about the overview of estate planning and what it entails. It is produced by the National Association of Estate Planners and Counsels. We will put the link in the chat for you. Does anyone have any questions? I don't know if there was any questions in the chat.
There are no questions in the chat, but perhaps there will be, and we certainly welcome them. But I did want to ask Sam a couple of questions. And, you know, I've seen advertisements about annuities and how they are perhaps not very beneficial for retirees. When might a charitable gift annuity be a benefit for helping in retirement income? Are they safe?
Yeah. So they are safe investment vehicles. If you're doing an insurance company purchased annuity, obviously you want to dig in and make sure that it's a reputable insurance company. In the case of a charitable gift annuity, yes, those also are safe. They're backed by the university. And somebody might want to consider an annuity when they are looking for fixed income, fixed monthly or quarterly income. And they also are possibly looking for a charitable income tax deduction. And they want to benefit the university ultimately. So you can see how it's kind of threefold intent, but oftentimes it's folks who are looking for some type of fixed monthly income.
Thanks, Sam. I've also heard about another way that people might have multiple benefits through a different way of giving, and that is a charitable remainder trust. Can you talk about what some of those benefits are and sort of how that works?
You bet. Yeah. So there are two types of charitable remainder trusts. One is called the Charitable Remainder Annuity Trust, and the other is called the Charitable Remainder Unit Trust. And I'll explain the slight difference between them. But the gist of a charitable trust is a donor puts assets into a trust, which is again, there's paperwork involved, right? There's a formal trust document that exists, and it spells out the terms of payments that will come back to the donor. Typically, a person, they tend to be larger donation amounts, candidly, certainly at least a few $100,000. And they're typically spelled out for payments for a certain number of years back to the donor or for their lifetime. Also could be set up to be for the donor and their spouse's lifetime. And depending on the amount that's donated, the repayment terms, the age of the donor will receive a charitable tax donation, but those factors affect how much that tax donation will be. A charitable remainder annuity trust, again, going back to that word annuity, means that the donor will receive a fixed payment typically quarterly, for a number of years or for their lifetime. A charitable remainder unit trust gets revalued each year, and the donor receives a percentage of that value, again, typically paid on a quarterly basis. The beauty of a charitable trust is that the assets of the trust get invested. And, you know, if it goes up in value over time and it's a unit trust, the amount that the donor receives each quarter actually goes up. The secondary benefit is, as the value of the trust investments go up, the university is actually going to benefit more in the future also. So it really is a win-win for the donor and for the university.
Thank you, Sam. There is a question in our Q&A, and the question is, can I donate from my IRA and not get taxed now? I'm 68.
That's a great question. Thank you for asking that. To be able to withdraw any money, let me back up. To donate from the IRA to the charity, you must be 70 and a half years old. And it's 70 and a half plus a day. I mean, it's very literal to the date. So I believe the answer to that question as it's posed is no, you must be 70 and a half years old to make a qualified charitable distribution. However, you know, because you are older than 59 and a half years old, you know, of course, that you can take a distribution from your IRA and not pay any penalties on it. But unfortunately, yes, you will be taxed on that distribution. Depending on your personal situation, if you make a charitable donation, you may get the benefit of that charitable donation. And so the net effect is you wouldn't be taxed on it. But that IRA distribution is taxable income too.
Thank you, Sam. Speaking of staying with IRAs, you've mentioned some ways that make sense to utilize IRAs. Is it an either or proposition? So for example, perhaps I have a surviving spouse who's going to be the recipient of my IRA, but I'd also like to have some go to St. Martin's. Mm-hmm. How does that work? How do you do that?
No, that's great. So under, I think it was our fourth topic, we were talking about naming a university or a charity as a beneficiary. And what you can do in that situation is name the university as a beneficiary of your retirement account and also name your spouse. And you can specify a certain dollar amount to go to the university with the remainder to your spouse, or you can specify percentages. I have a client who wants to give a certain percentage to charity and the rest split among people. So 10% going to the charity and 30% going to 3 individuals. In your example, 20% or 10% or whatever to university, the remainder to surviving spouse.
Thank you. That was valuable information. I didn't know I could do that. One other question has to do with donor advised funds. With the generally with folks that you encounter, can you explain a little bit about a donor advised fund and when that might make good sense and how you can make charitable gifts through donor advised funds?
Absolutely, absolutely. I'm glad you brought that up because there was one comment I meant to make earlier, and if you don't mind, I'd like to make that comment now and then answer your question. When we were talking about qualified charitable distributions, again, have to be 70.5. It's a payment directly from my IRA to a charity. You cannot make a payment from an IRA to a donor advised fund. That does not qualify as a qualified charitable distribution. But a donor advised fund typically is established, at least locally in the situations I've seen, established through our local community foundation. And the situations I've seen are where people want to make a large charitable donation, oftentimes for tax purposes in a specific year, but they don't quite know what charity to give the money to. So what they can do is again, in our situation, go to the local community foundation and work with those folks to establish Sam Armour donor advised fund, and then make a donation, a transfer of assets, cash or maybe stocks that have gone up in value, to the donor advised fund. They receive a tax deduction in the year of donation. But then through the donor advised fund, they get to trickle out donations to various charities over time. And the amounts that are donated to the charities and the charities themselves can vary year to year. So like I said, it's a way of making a larger tax deductible donation at once and then making distributions to the charities themselves over time. And they're pretty easy to set up. And they're very effective tools. And you can continue to make donations to donor advised funds over time. It's not just a one and done.
Thank you, Sam.
Excellent.
Bobby, back to you.
Well, thank you for being here today. I didn't see any other questions, but if you have further questions, you can always reach out to Nate Peters or myself, and we can get those answered for you. A special thank you to Sam Armour for taking his time and sharing his expertise with us today. Finally, you will receive a post-event survey to help us evaluate this session, and stay tuned for another education session scheduled for Thursday, November 21st at noon. Thank you.
Thank you.